Welcome back, Dr. Malcolm.
Thank you, Nika.
Everyone has a banking relationship, but what are some of the current conditions under which banks operate locally and internationally?
Once a bank gets a license to operate in any jurisdiction, the license under which they function will set out what it is that their obligations are, will indicate clearly what their regulatory responsibilities are, who it is that their regulator will be, and other matters to indicate what they should do from day to day under the licenses that have been granted. Now, in the context of many jurisdictions, certainly in the context of our regional jurisdictions, Caribbean regional jurisdictions, the banks function under an arrangement where they receive those licenses and are regulated by the central banks. So in the case of Jamaica, for example, it's the Bank of Jamaica. In the case of St. Kitts and Nevis, for example, it's the Eastern Caribbean Central Bank. In the case of Barbados, it's the Barbados Central Bank. In the case of the Bahamas, it's the Central Bank of the Bahamas. And these things will happen in terms of the regulatory relationship that is established. Now, what will then happen is that as regulator, the Bank of Jamaica, for example, in the case of Jamaica, will have certain guidelines that determine what banks should do and how it is that they monitor the operations of those banks. And in our case, the Bank of Jamaica operates by reference to what we call a Prudential model for regulation. And what does that mean? The bank will effectively examine the operations of those institutions that they regulate to see that they are carrying out their functions in a way which have regard for good financial practices and for ensuring that they don't run insolvent and they don't put the customers' monies at risk. And why is this important? Banks themselves are there, in a traditional sense, to operate as a place where persons can put their money. It becomes effectively what we call a store of wealth. And I must hasten to indicate why I made that distinction. What it is that if you think of a bank as part of the traditionally considered financial sector, the financial sector effectively includes three types of institutions. You have bank, you have insurance companies, and you have securities companies, right? The securities industry is established to do what we call a wealth creation purpose. You invest in stocks, you invest in bonds and so on with a view to creating wealth. Then you go to the bank where you then deposit your funds and your bank becomes a store of that wealth that you have created. And then you have insurance, which is there to effectively protect that wealth. So you take out insurance policies to protect your health, to protect your car, to protect whatever it is that you're protecting. And what you're doing, let's use a car, for example. When you insure your motor vehicle against third-party risks, right, of an accident happening and so on, what you then do is that you insure it on the basis that if it is that you get into an accident, the insurance will jump in to take care of the liability that has been created. So to that extent, you do not then have to dip into your financial resources that you have stored as your wealth at your bank. So this is how the traditional context of looking at the three arms of the financial sector operate. However, in practice, you do have some levels of overlap. And you do have some level of what we call convergence in the financial sector. So you have banks offering products which appear to be more insurance by nature. Insurance companies offering products which have investment components, which is wealth creation, and so on. So you have that level of interrelated activities within the sector. And it is made worse, of course, sometimes, because very often you have these financial holding companies that may have different entities operating in the different arms of the financial sector. So to that extent, there is some level of intermingling and so on that happens. But if we get back to where you started by getting to banks, the banks then are there and are regulated to ensure that they are adequately able, or should be regulated in any event, to ensure that they are adequately able to take care of preserving and protecting the store of wealth that has been lodged with them by their customers.
You said they're the store of wealth, but there's also the business of banking. Talk to us about the business. What does the business of banking mean? How do you interpret that?
The fact that you become a store of wealth is really, as I said, it's a shorthand way of talking about the more holistic approach that banks take. Because when you take your monies to a bank, the expectation is that the bank will keep that money for you, and they will hopefully be able to pay you an interest on your money. So in order to do that, what do they then have to do? They then have to themselves invest and use that money to be in a position where they can work it for you, for themselves really, in a view, so that they can be able to pay you back your money when you require it. So what the business of banks then include is that it includes lending, and it includes engaging in other services which are fee collecting services that enable them to be able to return your money to you with interest, as the case may be from time to time, right? So the business of banking is now a business which says, we have your monies to hold, but we then have to use that money, which will allow us to be able to give you and to maintain the store that you have given to us for keeping. So that is part of what the business of banking is about. And in that context, it's a whole interconnected ecosystem. Because a bank, for example, operating in any given jurisdiction, let's say Jamaica, they operate as what we call financial intermediaries, right? So they are intermediating between the customer and the relationships that they need to have to be created. So for example, when you go to the bank, you may want to, for example, send a transfer from Jamaica to Trinidad or to Suriname or wherever. And the bank operates to intermediate in that transaction to allow a seamless transfer of those resources. So, but what then does it have to do? The bank will then have to ensure it has created relationships in those other jurisdictions, either directly or indirectly, which allow for that seamless transfer through the international systems that are available for the bank transfers to happen. So the banks do perform in that function. And in doing that, what then happens? The banks that you and I will go to, who then are our bankers, will then end up in circumstances where they too have their own bankers.
Is there a dispute management connection to banking and banking relations?
Well, clearly, because as I've just mentioned, the relationships that you have operating in bank are all contractual. So there's a contract between bank and customer. There's a contract between bank and its own banks. Under a contract, just to recap a bit, is an arrangement which regulates relationship between parties. So what it does is that the contract will establish performance obligations of the respective parties. And once you have performance obligations established, you are under requirement to act in accordance with those. And if you fail or refuse to do what you're supposed to do, what has happened? You have created a dispute that needs to be resolved. So in the context of banking at every level, there are always potential disputes. And when those disputes in fact manifest, they need to be resolved.
OLINT and NCB. Let's talk about that landmark case. What are some of the takeaway issues that were involved in that case?
Well, for those persons who are not aware, OLINT and NCB is a little dated by now, but not in the context of the principles that came out of it. But in short, what had happened is that in Jamaica, there was an entity called OLINT, which was in the business of assisting persons in doing foreign exchange transactions. And they were operating and had, among other institutions, established banking relationships with the National Commercial Bank of Jamaica. And there came a time when the business of OLINT was considered to be risky, and in fact subsequently found to have been unlawful at many levels in different jurisdictions, right? So what happened when NCB found itself in a position where they were dealing with OLINT as a customer, they then got to a stage where their own appetite for doing business with OLINT was lost. And they decided that they would, in fact, disengage from the relationship they had with OLINT. And having decided to do that, a court case ensued. And that court case...
Disengage, Doc?
Disengage meaning they decided to terminate the banker-customer relationship, right?
Okay.
So they decided to terminate that relationship. And in doing so, OLINT then decided that they really were not in a position where they should have sought to terminate in those circumstances, and they brought an action in court to challenge the decision that had been made. Now, the action, to give the short précis that I'm looking at, continued all the way up to the highest court of Jamaica, which is the Judicial Committee of the Privy Council, which is in London. And the court ultimately decided there in favor of NCB by establishing the principle that NCB was able to terminate a relationship with Olint, notwithstanding any other contractual or other relationships that may have existed. And the significant point coming out of it, by principle, if you want to look at it that way, was a determination that the bank had an overarching obligation to preserve its own well-being and to preserve the well-being of the economy that it served as a whole. And they should not jeopardize that obligation by reference to any single customer who was involved, who or which, as the case may be, was involved in business activities which was inconsistent or incompatible with their regulatory and other obligations. So the court decided there that Olint was, in substance, a bad customer, and that Olint had, and that NCB rather had every right to terminate the relationship, and that is where the case ended. But that having happened, of course, the principles went a little further, because once, even though it was determined on that basis, some of the factors that came in, of course, was the fact that NCB, in offering services to Olint, was also in the peculiar position, of course, where it in turn had overseas banks in relation to which it was itself a customer. And those banks had found the business of Olint and what was being engaged in something which was problematic for them and for which they had no appetite. So the position that NCB found itself in substance, was, do you want to continue with Olint and lose your external banking relationships? Or do you want to terminate the relationship with Olint and be able to preserve and maintain your external relationships? And why was this important? Because at the end of the day, the business of NCB was to offer banking services which could reach out to the world. And a significant party that operated were their banking relationships that they had with banks in the United States of America. And if they were to lose those banking relationships, the business of banking that they operated and the nature in which they were able to function would effectively be minimized to not much. Because the truth is that in the current world that we're in, the US banking system and being able to engage with it is critical. And so in those circumstances, the court, having looked at all of those factors, determined that the bank was responsible in making the decision to terminate, and Olint had no proper reason for concern. Well, for complaint, not concern, for complaint.
Coming out of the ruling, were there continued implications?
There are continuing, I wouldn't even say continued, continuing implications, because the truth is, what came out clearly there was a situation where you had effectively, even though the decision, as I've mentioned it, appeared to have been determined shortly in that way, there are still issues relating to the nature of banking, including by reference to license, as I see it, that may or may not have been looked at or dealt with in a way which could be holistic, if you want to think of it that way. And why do I say that? If the bank, as I said earlier, effectively gets its license from the people through the government, and there are obligations to serve the people, and the banks were to decide to take decisions which effectively make persons unbankable, meaning they can't access the banking system. Where then do you go? And you complicate that a little more, that in the case of Jamaica, there's law which effectively says that you cannot transact in cash for amounts exceeding $1 million or whatever the figure is now. And if you then put persons in a position where you say, if you are conducting cash transactions in excess of $1 million, except in special circumstances, you are guilty of a criminal offense, and those persons do not have access to engaging with the banking system, which will then enable them to avoid conducting those transactions in cash. What then do you do? So there are those issues. But of course, there's always a balancing of it. But I would say that the issues, certainly from an academic perspective, if you want to take it into that realm, are issues which still need to be ventilated. And I think as well, which is interesting, is that at the time, NCB took a decision against Olint as a bank customer, citing the lack of appetite for what Olint was then doing. And we were able to say, well, we have satisfied our obligations, we have done all these things. But the interesting part to it, of course, is that when their own correspondent banks, and I'll tell you correspondent banks and what we're talking about in a minute, when their own correspondent banks come to these banks and say, we no longer have appetite for you, interestingly enough, they're using the self-same arguments that NCB was able to use successfully against Olint, to use against these banks to say, we no longer want to do business with you, and then issues arise. And just quickly to mention it, I use the word correspondent bank. What exactly does that mean? What happens is that in every jurisdiction, you have what would be considered banks operating in their home territory or home country, right? So home country banks, effectively. But they, as I said earlier, need to engage with the world. So in the case of Jamaica, for example, we use the Jamaican dollar as our currency. And we effectively have control over the Jamaican dollar through Jamaica because it's our currency. If you're engaging in a US dollar transaction, for you to really have value in substance, at least in theory, given to that US dollar transaction, it needs to be settled on a US bank. So in substance, you may take out of your pocket a US dollar $1 note and show it to me here in Jamaica. In substance, that $1 means nothing until it is settled on a US bank, because Jamaica does not have the capacity to control or manage the US dollar and what it means. That is a matter of national sovereignty, and there's authority that speaks to that, the fact that your currency is effectively a part of your sovereignty, right? So the sovereignty in relation to the US dollar is in relation to US bank.
Yes.
So in that situation there, you really need to have an institution in that home country, and I use the US, but it could be sterling in the case of the UK, it could be the Canadian dollar, it could be the Chinese yuan, it could be all sorts of things that are there that you have to look at. So what you always need, if you want to engage in trading relating to another currency, is a relationship that allows you to have access to a portal, i.e. a bank, that you can net and set off the currency you have relating to them, because that is how you get effective rather than nominal value.
The relationships that banks need to have, the external relationships that they need to have, international relationships. Have we seen examples where those relationships have fallen at any risk?
Banks will, on an ongoing basis, institutions generally, will look to their customers and look to the business activities of their customers to determine whether or not the business activities of their customers are things that are compatible with what they're doing. So the whole idea is that banks operate on a risk responsibility basis. So banks will undertake risk, but they will do so in accordance with what they deem to be compatible with their own profiling and what they're prepared to manage and have appetite for. So when a bank examines on an annual or other basis the nature of the business of their customers, and you know, as you go to banks and they have these KYC forms, they call them Know Your Customer,
Right, know your customer.
and you morph that even to go to Know Your Data-driven approaches to examining customers and what they do. They are doing that really to develop a profile of who you are and what you do, to determine whether or not your profile is something which is compatible with what they do. And from time to time, they will re-engage you to get additional information to determine whether or not your profile remains the same or has changed, and may have changed in a manner which says we are no longer prepared to do business with you. So when they decide not to do business with you, what they are doing is that they are deciding no longer to take that risk. So that is how the de-risking comes about. I have decided to no longer entertain the risk you provide. And that is a de-risking of it. So what happens is that individual banks, say in Jamaica, will take risk, will take that thing and in relation to their individual customers to determine whether or not they want to keep you. And if they don't keep you, you have effectively been de-risked, meaning we're no longer prepared to entertain your risk. But they too are subject to their own banks, who will also have them go through the same Know Your Customer profiling. And what they will do as well is determine a de-risk. Now the banks have an even added layer to it, because when they are being examined by their own banks, the banks are looking at their business, but they look to the business of their customers as well. Right? So it's a chain which involves persons examining in a very holistic way the nature of the underlying relationships that exist to determine whether or not the risk profile, individually and more generally considered, is that which is capable of being handled or which they want to handle. And if they don't want to handle it, they say, we're no longer prepared to do your business, and that is how the de-risking comes about.
Help us to understand another concept, bankability.
Well, bankability is usually used in relation to projects and so on. So let me indicate what that means. Let's say you are you're trying to engage in the business or enter the business of planting castor beans to produce castor oil. What you will do is that you will create a company profile. You will indicate to the bank what it is that you intend to do with your business and how it is that you intend to be able to recover and be able to pay them. Because banks are keen not just on lending you the money, but they want to be able to recover. Why? Because remember, they have customers whose monies they're seeking to protect, and they need to ensure that the business that they engage in is business that will allow them not to deplete the resources to a point where they will never be able to repay if called upon to repay.
That's right.
So what you have to do when you go to the bank is go to the bank with a project which is sufficiently scoped and so presented that the bank is prepared to say, we are prepared to accept this and be able to deal with you in accordance with what you have presented. So what you then go to them with is something which the bank will accept, and that is what gives rise to the concept of bankability. Bankability really is going to the bank with a bankable project, which the bank is prepared to accept. So you go to them having established that there is bankability in the project that you're taking to the bank.
Interesting. Doc, so far we've learned about de-risking and bankability, but tell us a little bit about how does a bank terminate a customer relationship, a bank customer relationship?
The first thing you have to do when you're considering termination of a contract, whether you're a bank, an
maybe
employer
as part of the
any sort.
de-risking or so on.
Well, if you talk in the context of de-risking, that raises other issues. But even in the context of de-risking, there is a contract. So you have to ensure that the contract is properly terminated in accordance with its terms. Mm-hmm. Now, one of the things that the banks will do is that they will have customer contracts which provide for them to take reasonable and responsible risks in relation to what you do. And the banks will generally have the discretion to decide whether or not to continue with your business, right? Mm-hmm. So if it is, for example, that you are in the business and the bank sees, and that is why the banks will again go into your profile. Because let's say you're in the business of lodging with the bank, $20 every week. And there's 1 week in particular that you come in and you lodge $2,000. Immediately, what will the bank do? It will raise its suspicions.
Right.
And the bank will monitor your transactions. And if they see things which are unusual and unexplainable and cannot be explained, what is the presumption that the bank is going to make? That something bad is happening. And that this may be unexplained wealth or unexplained resources that you're getting. And it is not unusual to then extend that to say it is possible that the source from which you're getting that may not be all above board, right? And if the bank comes to that decision and is able to satisfy itself that, in fact, this is business that has now gone from suspicion to taking us to a point where we believe there is likely to be an underlying, what we call predicate offense for money laundering, for example, meaning something that is capable of being established as a crime or something else to create the predicate for doing something else. And money laundering is something which banks are against. Banks will not be there to encourage and support money laundering or the financing of terrorism activities. So if the bank, for example, gets the impression that you're being used as a channel or a funnel for monies coming from dealing in opium, which is illegal in Jamaica and elsewhere, right? And some other such activity, you're in the business of getting money coming in from human trafficking or some such thing. And it is satisfied that those things are not things which are compatible with what they do and may in fact also be unlawful and illegal. then the banks in those circumstances say, no, we don't want to be associated with this type of activity, because if we are, and it is shown to be, our own banks will have difficulties with us. The banks are under an obligation, under their suspicious activity reporting obligations and so on, to make reports of things that they consider to be suspicious on an ongoing basis to their regulatory authorities, which then have an obligation to investigate and to do whatever is required. Why? Because you want to ensure that the financial sector does not become a funnel for dealing in illicit activity.
There are some other issues like money laundering, terrorism financing, I should say, and scamming. Let's talk a little bit about those, and how are those putting banks and the financial sector at risk?
We can't fool ourselves into thinking that money laundering does not happen and that people don't escape with it. It happens.
Right.
But the fact is that the banks, in their gatekeeper roles, for their own integrity and for their own protection, have an obligation to ensure that they prevent this from happening, because, again, they too could become de-risked. And if they become de-risked, it's a risk not just to them, but to the economies in which they function, right? So you want to ensure that you avoid that to the maximum extent possible. So money laundering, if I were to say it, it's difficult to say, here is what money laundering is, except in a very general way that I've given it. But there are what we call predicate offenses, meaning you have to do something which becomes the basis for which you're able to establish money laundering. So it could be drug dealing, it could be relying on the earnings of prostitution in jurisdictions where prostitution is unlawful. It's not unlawful in every jurisdiction, so let us get that clear. It could be relying on the earnings from some gangster-related activity of one sort or another, right? So there are those things which could give rise to that. So that is where money laundering sort of falls in. We talk about terrorism financing, and that's a whole new big thing, because terrorism financing, interestingly enough, the source of the funds may be good, but the ultimate end for which it is being used is bad.
Yes.
So you have legitimate proceeds, legitimate monies, but you want to finance the activities of somebody who's carrying out the activity of genocide in another country or some other such thing, right? Or the acts of some mercenaries in one place or another, which then leads to domestic or international terrorism or whatever the case may be. So again, in that instance, you're looking, it's different sides of a coin, in that both are endangering the integrity of the system, but for different reasons. Money laundering starts with a predicate where the source from which the money comes is bad.
Right.
And that is where the money laundering comes in.
Right.
Whereas terrorism financing could as well include starting with a place where the money is bad, but not necessarily.
Usually, right.
You could have a situation where the source is legitimate, but the ultimate end is bad, and you're trying to protect from both sides. Now, scamming, for those persons who are not aware of what we're speaking about when we think about scamming, scamming really are those activities that are engaged in by persons who pretend and create stories that allow people, through trickery, to give up access to their own monies. If we want to think of it in that very simple way. So what would people do? Persons will come out, let's use a common one which they call the lottery scamming, for example. Persons will call and pretend to be legitimate persons who are connected to a lottery, claiming that you have won a lottery. But in order to collect the monies, you need to pay over a certain sum, and they give you bank details and so on, into which you must make your payments and so on, right? Or remittance entities to which you must send money. And some persons, in fact, fall for this, notwithstanding that they have never bought a lottery ticket in their lives. They somehow think they've won a lottery in a game that they have never played. But it happens. And what happens, which is very sad about the lottery scamming and those sorts of things, is that very often it's vulnerable people who are targeted. The core of scamming is what? Information gathering. You gather information and you create a good story around it. And then that becomes the basis of scamming.
Why is that dangerous, though, for the financial sector?
It is very dangerous because, again, what you now have is that the financial sector, again, getting back to the nature of the interconnected nature of it, is that instead of operating and serving a legitimate goal, it now becomes a funnel or a channel for the pass-through of illegitimate monies or monies that have been gained through illegitimate means.
Earlier we spoke about the relationships and international relationships. Have we seen economies that have faced some sort of de-risking in any sort of way?
Countries as a whole don't really face de-risking per se. What you have happening is that the underlying industries or underlying sectors within the economy may face de-risking, which then has knock-on effects for the economy as a whole. And in the context of the Caribbean, for example, we have seen specific countries, I won't necessarily call any of them, and in other countries as well, in other regions as well, where the banking sector as a whole has faced the real risk of pretty much almost all or most of their previous correspondent banks having simply said, we're no longer prepared to do your business. And sometimes, to be clear, sometimes de-risking is not always about the illegitimate activities happening. Sometimes institutions in bigger countries, which invariably you need for your correspondent banks, take the position that the business you're offering doesn't allow us to make enough profits. So there's a profit motive sometimes that is at the core of de-risking. And that is something that we have heard international institutions speak about in the context of the region. We've heard the Caribbean Development Bank, we've seen things coming out of the IMF and other institutions that are saying that de-risking really should be managed properly, because if you're not careful, the fact of de-risking improperly managed could undermine the global financial system and render persons and institutions unbankable that should not be.
Generally speaking, do banks have an obligation to serve the best interest of their customers and or support economic development?
My own view, yes, they do. And if I go back to where I started by saying the banks really operate at the behest of the people, however good a business plan is that you have, and however great your objectives are, if you don't have money, it won't happen. And in developing in other countries, wherever you find people, very often people are not so able to simply pull out of their pockets all the resources they need to allow a business to develop. They need banking support.
Yes.
Not just for loans and so on, but also to be able to engage. So for example, let's say a business being developed in, let's say Barbados, which is a small economy, and you want to interface with the globe in terms of selling your products and buying raw materials. In order to do that, let's say you have a supplier in China, right? When you engage with that supplier, the supplier will say, we need to be paid, and they must, right? Nobody's going to offer you anything for free.
Right.
And if they want to be paid, they said, here are our banking details. Now, if you don't have access to the banking sector and the banking sector is not effectively serving you, how will you be able to make that payment?
Can't.
You can't. And if you have provided a good or service and the person needs to pay you, and there is no easy way by which they can transact across borders to send monies to you, how would you get it? And we're operating in an environment, of course, where it is unlikely, particularly in small economies, that there's any business that can operate without relying on things which are coming from other jurisdictions, other countries, right? And the way to interface with other countries is to do through the financial sector. And in many instances, bank and near banks and so on, that will provide those intermediation services that will allow for businesses to develop and thrive. And in doing that, the bank is doing something else. It is serving a broader economic function for the economy as a whole. And so it all ties back, And we all sometimes get lost in so much in our individual areas of practice and what we're concerned about, that we forget that it takes the whole to function. There are complementary parts, and they all must work seamlessly together if we want to get the best out of ourselves and out of the economies in which we function. And the banks are critical to that, and they too must function in a way which recognizes the overarching obligation to attain sustainable economic development for the good of all, including themselves.
Finally, Doc, talk to us about how dispute management becomes significant to the area of banking and the future of banking relationships.
Banks also function in an environment where it is in their best interest to maintain good relationships with their customers. And if you're maintaining good relationships with your customers, then you want to avoid as much as is possible adversarial proceedings such as taking lawsuits against them, meaning litigation in courts, or even going to high stakes arbitration and those sorts of things, unless it is absolutely necessary. So what banks, I think, in future, some are already doing it and more need to do it probably, is to engage more in amicable methods of resolving disputes using mediation, conciliation, facilitated contract renegotiation, and those mechanisms which are much softer and which are much more geared to relationship building and sustenance rather than relationship breaking up. And that, I think, has to be the future. And if we go there, we could see a lot more centering of people in relation to how they feel about their banks, and in relation to how it is that they also engage with their banks, and in relation to how the economy as a whole benefits from this much more interconnected and good relationship that flows between bank, customer, and ultimately to the economy as a whole.
So far, we've learned quite a bit, and we will continue our discussion on banking relationships in part 2 of this series. Now, Doc, before we go, we need to do our Did You Know fact for today. And it says, did you know that the JAIAC provides support for the conduct of domestic, regional, and international arbitration, mediation, adjudication, neutral evaluation, and other services under its rules? You can contact the JAIAC at 876-416-5390 or at info@jaiac.org for more details. Now that's where we wrap things up for today's episode. Please remember to tune in to each of our bi-weekly Dispute Management in a New World podcast episodes available on Buzzsprout, Podbean, Spreaker, and the JAIAC's YouTube channel. It's sponsored by the JDIC, protecting deposits for you and me.
I save because one day my little business is going to be a big deal.
Yeah, and I make sure to put away a little something for him.
And thanks to JDIC, deposit insurance protection on my savings gone up.
You've been upgraded. Deposits held in commercial banks, building societies, and merchant banks are covered under the JDIC deposit insurance scheme up to $1.2 million per depositor per institution. JDIC.
Protecting deposits for you and me.
I'm your host, Anika, saying on behalf of Dr. Christopher Malcolm, thank you for joining us. Special thanks to ADEB Consultants, consulting engineers in the Caribbean for over 57 years. Regis, Work Your Way, Caribbean Institute of Alternative Dispute Resolution, Wassell & Wassell Arbitrator Services Incorporation, iNeutral Dispute Resolution Made Easy, CP Malcolm Dispute Management Practitioner, and Impact Justice, improved access to justice in the Caribbean.
Work wherever your business takes you. Regis workspace locations are in every major town, city, and transport hub worldwide. So startups, global companies, and every business in between can work near to clients, suppliers, or family. Regis offers many different ways to work, so you can find a work style adapted to your professional needs. Check out our membership solutions. Book your tour today by calling 876-618-8800 or visit regis.com.jm. That's regus.com.jm.
All our episodes are also distributed on Google Podcasts, Spotify, Apple Podcasts, Amazon Music, Deezer, Stitcher, Podcast Index, Pandora, TuneIn Plus Alexa, Podchaser, Podcast Addict, and wherever else you get your favorite podcasts.